Good morning, everyone. Sergeant Clark here with Sergeant Clark's Trades. Back today for another video. Today we're going to talk about the financial statement that Citadel Securities put out this weekend that I've seen a lot of people talking about. There's obviously some big takeaways from here, but there's a few things that I think are being overlooked that have even more impact on our current situation. So obviously one of the biggest things being talked about is this. If you look here, it says that all of these numbers are expressed in millions of dollars. So the biggest one that people have talked about is under the liabilities category, the securities sold not yet purchased at fair value, which is short shares. So with that saying 57,000, that's actually $57,506,000,000 worth of short share value. So that's an exponential number in itself, but it is balanced out up above by the securities owned at fair value, which is their long value. So they have $66,707,000,000 in assets from their long positions. So while those two balance out, the thing that is completely out of balance in regards to the short shares is up here under assets. They only have $523 million in cash. Now, if you were a company who takes risk and you were to have $57.5 billion worth of liabilities out right now just in short shares, don't you think you'd have a little more than $523 million in cash on hand to help cover those shares? I mean, to me, that makes sense. Because as soon as those short shares values, the positions that you're short in start to increase, your value of those shares increases as well. So that $57 billion could greatly increase every time these stock prices are jumping. Because there's no telling how many actual short shares they have. How many are synthetic and everything, that's still to be determined. But looking at that is over 100 times as much value in short shares as they have cash available. Now, as I said, they do have the $66 billion or $66.7 billion worth of long shares. Well, obviously that's what they're going to tap into first before the cash to start covering those positions, if they're smart at least. But what that means is all these companies that they're long in are really going to start hurting soon. I've covered this in other videos. Other people have covered it. They are going to have to start liquidating those long positions to cover the short positions. And that's great for us because that means the squeeze will happen. That means they're going to be buying back those shares. And with them having that much liquidity to start buying those back, they can only do so much because, like we said, as that value rises on those stocks, on those short shares, the value of the other ones are going to be dropping as they're selling. So they're not going to have as much liquidity coming from that. So it's going to kind of go in opposite directions, and depending on how fast they're able to get rid of those positions, they may not legitimately be able to cover all those positions. I mean, even with the cash on hand and the long positions that they hold, with how fast these short squeezes could run up, they probably won't have enough to cover, in which is the case where, they do have to tap into that insurance. So that is one aspect of what's going on these balance sheets. One of the other things I noticed, though, is all the way down here on page 14. Which is under note 7, you have accounts receivable and accounts payable. Now, accounts receivable is money that they are owed, whether from, in this, they broke it down into brokers and dealers, and then from clearinghouses or clearing organizations and custodians. So between those two, the total comes out to about almost 1.5 billion. However, what they owe, their payable, is $2.8 billion. So that means as of December 31st of 2020, not including anything from the past 4 months that have already transpired, they owe twice as much money to companies and brokers and everything else than they are taking in. They are hemorrhaging money right now. And this was, like I said, as of December 31st. That's not including all the money that they've been hemorrhaging through this year already. We've seen the reports of the billions of dollars that hedge funds have lost just in quarter one. And that number is going to continue to grow as these squeezes start to transpire, the new regulations coming out. 002 did get pushed back, but 006 is in effect. 801 is in effect. And both of these will have huge impacts on these hedge funds, especially Citadel looking at this. And keep in mind, this is the company that is responsible for, and self-admitted, to 50% of all of the market maker action that is going on in the stock market. It's been said in these in all these government litigations going on right now, referencing GameStop. Gensler's talked about it quite a bit. All the politicians are sitting there arguing everything back and forth, which, by the way, Gensler is on our side. If you've paid any attention to the interviews, anytime politicians start to bash retail traders, he immediately cuts it down, stands up for us, calls them out on their BS, and then keeps the proceedings moving. He doesn't allow them to drag our names through the mud. So, with all this being said, if you look through this, everybody, like I said, everybody's concerned with this right here, this $57.5 billion in short shares. But it doesn't tell the whole story, because this is only as of December 31st. They doubled down on their positions last year, and we've seen them continually run up these short numbers. And it's possible they've already doubled the number of short shares that they have this year compared to what they finished last year with. They went from 27 to $57 billion in short shares. So this is all good news for us, y'all. I'm trying to break this down as plainly as I can. Citadel is kicking the can down the road, but they're running out of road. They've run out of ammunition. They've run out of short shares, especially with AMC. We saw the percentage go from 11.2% at market open to finishing the day and going into the weekend at 26.5 or 26.6% short interest fee. We're winning this battle. We're going to keep winning. There's a lot of good things coming up. We hit that 951 mark this week, this Friday. That was another huge win. And if you watched it, it was just like watching that battle for 801. Very stressful, very intense, but we pulled it out. We just keep getting victory after victory. In June, we have that the shareholder count for the actual legitimate shares coming out, all the information on that. There's just so many things to look forward to this month, going into next month, and no reason to believe that short squeeze isn't right around the corner. We don't know when, we don't know how big. All we know is we control the stock, we control the float, we control our future, our lives, and we control where we sell. So with that being said, that's all I've got for this video. Drop a like, subscribe. We'll put out some more content this week. Otherwise, you all stay blessed. Have a great day, and I'm out.